Both are 30 years old. Both make $55,000 a year. Both have exactly $50,000 saved. And both are determined to build wealth. But they choose completely different paths. One buys real estate. The other buys index funds. 20 years later, both of them are financially successful. But the road they took couldn't be more different. And once you see the numbers, you may never look at investing the same way again. Meet Jake. Jake loves real estate. He spends hours watching property videos, scrolling Zillow listings, and listening to investors talk about passive income. To him, owning rental property feels like the fastest path to financial freedom. So he takes his $50,000 and uses it as a 20% down payment on a $250,000 rental house. He gets a 30-year mortgage at 7% interest. His monthly payment is about $1,330. A tenant moves in and agrees to pay $1,800 per month in rent. Jake immediately sees what looks like a $470 monthly profit. He feels like he's cracked the code. Now meet Marcus. Marcus isn't interested in managing property. He doesn't want tenants. He doesn't want mortgages. And he definitely doesn't want a second job. Instead, he puts his entire $50,000 into a low-cost, total stock market index fund. Then he sets up an automatic contribution of $300 every month. And that's it. No complicated strategy. No stock picking. No market predictions. Just consistent investing. His friends think his plan sounds boring. Honestly, Marcus thinks it's boring too. But he sticks with it. At first, Jake looks like the clear winner. He owns a Real house. He has tenants. He collects rent. He can literally drive by his investment and see it. People ask him questions. People are impressed. Marcus has none of that. He just has numbers on a screen. No exciting stories. No rental income. No visible proof of success. And that's important because investing is emotional. People naturally prefer investments that feel productive, even if the numbers tell a different story. For the first few years, Jake loves being a landlord. Every month, rent arrives. His property slowly increases in value. His mortgage balance slowly decreases. He's building equity. He's receiving tax benefits. And he's using leverage. That's the secret weapon of real estate. Jake invested $50,000. But he controls a $250,000 asset. That's a 5-to-1 advantage. If the property's value rises by just 4%, Jake doesn't earn 4% on his original investment. His gains are magnified. That's why so many wealthy people love real estate. Leverage can be incredibly powerful. But leverage comes with a price. A price most people don't talk about. Because while rent comes in every month, expenses show up eventually too. The first surprise arrives when the water heater fails. The repair costs over $1,000. A few months later, there's a plumbing issue. Then a tenant moves out. Now the property sits empty for several weeks. No rent. But the mortgage still has to be paid. Cleaning costs appear. Advertising costs appear. More repairs appear. Suddenly that simple $470 monthly profit isn't looking so simple anymore. This is where many new investors make a mistake. They calculate rent. They calculate the mortgage. And then they stop. But real estate is a business. Businesses have expenses. Property taxes. Insurance. Maintenance. Vacancies. Repairs. Legal costs. Capital expenditures. And eventually, major replacements. A roof doesn't last forever. Neither does an HVAC system. Neither does a furnace. These aren't surprises. They're guaranteed future bills. The only question is when they'll arrive. Meanwhile, Marcus continues doing almost nothing. His portfolio goes up. Then it goes down. Then it goes up again. Some years are fantastic. Some years are terrible. During market corrections, he watches thousands of dollars disappear on paper. It isn't fun. At times, it feels scary. But he keeps investing. Month after month. Year after year. Without trying to predict anything. Without trying to outsmart the market. Without changing his plan. 3 years pass. Jake has collected tens of thousands of dollars in rent. But after maintenance, repairs, taxes, insurance, and vacancies, His actual cash profit is far smaller than he expected. The good news? His property has appreciated. The mortgage balance has dropped. And his equity has increased. His wealth is growing. Just not in the way he originally imagined. Marcus has a different experience. His gains don't come from rent. They come from ownership. Ownership of thousands of companies. Every time businesses grow, innovate, and generate profits, Marcus benefits. And because he reinvests everything, compounding begins doing the heavy lifting. At first, the growth seems slow. Almost disappointingly slow. But then something changes. The gains start generating gains. And those gains start generating even more gains. This is where compounding becomes extraordinary. By year 10, something surprising happens. Jake and Marcus are much closer than most people would expect. Jake's property may now be worth well over $300,000. His equity has grown significantly. His rental income has increased. And despite all the headaches, he's built meaningful wealth. Marcus has quietly built a large investment portfolio. His monthly contributions never stopped. His investments continued compounding. And now his account balance has reached a level that finally gets people's attention. The boring strategy is no longer boring. The numbers are becoming impossible to ignore. But here's where the debate gets interesting. Jake's success required active involvement. Marcus's success required patience. Jake dealt with tenants. Marcus dealt with market volatility. Jake accepted debt. Marcus accepted uncertainty. Jake concentrated his investment in a single property. Marcus spread his money across thousands of businesses. Different risks. Different rewards. Neither path was easy. They were simply difficult in different ways. Then comes year 20. The moment both investors have been working toward. Jake's property may now be worth somewhere between $450,000 and $500,000. His mortgage is nearly gone. The rental income is stronger than ever. And his equity has grown into a substantial asset. The house that once seemed risky has become a powerful wealth-building machine. Marcus reaches the same milestone. 20 years of investing. 20 years of discipline. 20 years of ignoring headlines, market crashes, and financial predictions. His portfolio has grown dramatically. Not because he was smarter. Not because he timed the market. But because he stayed invested long enough for compounding to work its magic. And that's the part most people underestimate. Time is often more powerful than intelligence when it comes to investing. So who won? Jake or Marcus? The answer is neither. And that's exactly why this debate never ends. Because both strategies work. When done correctly, both can create financial freedom. Both can build six-figure wealth. Both can eventually create millionaire-level net worth. The real difference isn't the investment. It's the investor. Real estate offers leverage, tax advantages, cash flow, and the ability to increase value through improvements. Index funds offer diversification, liquidity, simplicity, and complete freedom from property management. Neither is perfect. Neither is guaranteed. And neither will make you rich overnight. The biggest mistake people make isn't choosing real estate. And it isn't choosing index funds. The biggest mistake is spending years arguing about investing instead of actually investing. Because wealth rarely comes from finding the perfect strategy. It usually comes from committing to a good strategy and sticking with it long enough for the math to work. So the next time someone tells you real estate always wins, or that index funds always win, ask them one question. Did you include everything? The repairs, the taxes, the leverage, the stress, the time, the risk, the opportunity cost, the compounding. Because the answer that includes everything is the only answer that matters. And the people who understand that